Welcome back to the Property Investing Roadmap podcast.
An investment in knowledge always pays the best dividends.
My advice is consider the long term, the medium and the now.
I'm your host, Damian Collins, here to help you navigate the twists and turns of property investing.
If you're wanting to snap up those opportunities in a competitive market, you need to be on the ball and be ready.
The first part is start early.
What's your goal in investing?
In Season 2, we're shifting gears to accelerate your journey through 9 key steps to financial freedom. From research and strategy to creating a model property portfolio, this is your step-by-step roadmap to building an income from property for life. In this episode, we'll be covering Step 7 of our journey through the 9 key steps to growing an income from property for life. Step 7 today looks at property development as a high return strategy. Now, while much of our focus so far has been on buy and hold strategies, which are absolutely critical, development offers another path to wealth creation. But is it the right fit for your portfolio? Today we'll explore opportunities and challenges of property development and how it might align with your investment goals. To help us break it all down, I'm pleased to welcome back Phil Anderson. He's the Head of Development at Westbridge Funds Management. Phil joined us in Series 1, and today he's here to share further insights on how investors can successfully navigate the world of property development. Welcome back, Phil.
Hi, Damien. Thanks for having me back.
Good to have you back, Phil. Now, development, we know, certainly can deliver high payoffs. I'm sure people look at the rich list in Australia and they see a number of property developers on there, but it's certainly not for the faint-hearted, is it? Because for everybody who's made a lot of money, there's also plenty of people who've gone back and lost money, and so it's not for the faint-hearted. But look, let's talk about your first development project. Was it what you expected, and was there anything that surprised you? And tell me about that first project you did.
Yeah, look, plenty of surprises. It was a small subdivision and renovation in Leederville. I naively planned it was going to be a lot quicker than I thought, and with a lot less dramas. We found asbestos in the ground. We had delays with trades, lots of different issues, but in the end we got it done. A good result, and certainly sparked interest in property development.
And so when you said you learned some things, what were some of the things you remember back then? What did you learn particularly in that first development project?
So the value of contingency, so having some additional contingency for things that will go wrong, things aren't going to go exactly how you planned, and also just allowing extra time. It's always going to take longer than you first think. So.
Yes, that's always the great challenge: time and cost, construction costs, and we'll no doubt delve into that today. And look, when you're doing a property development, it does certainly potentially generate significant returns, but it does carry high risk, and I'm sure we'll talk about that further. And but for property investors who've got a bit of wealth and have a high risk tolerance, because you need that for development. You can get 18% per annum if things go well. When might an investor consider adding development to their property investment strategy?
So look, you can get much higher returns potentially than passive property portfolio. So as you've built up that wealth, if you're in a capital growth sort of phase in your property journey, that's a good time to add it potentially to your strategy. But you need to be aware of the risks and be comfortable with those risks and be able to live with them, which is why we're looking at those 18% plus returns. The higher the risk, the higher return you should be getting on that investment.
Yeah, it's definitely one where you need to have some wealth behind you, and you've got to be prepared to potentially lose some of that money, don't you? It's one of those things. Yes, you can over a 3-year journey. You might get 50, 60, 70% return on your money, but it can also go the other way if things don't go well. So. We mentioned 18% return. Now that's generally for the bigger projects. On a smaller scale project, what sort of returns should investors expect to receive from the development?
So at a minimum, probably on a margin on development cost, you'd be expecting a sort of 15 to 12% return plus. That's for a subdivision or a lower risk development. As we move up that risk scale, I'd expect that return to keep going up. And for a large apartment development, it might be 20% plus.
Yeah, I think that's an important thing for anyone listening to the podcast. The smaller scale developments, you're generally going to make a lower return simply because they are lower risk. There's a lot more competition in that space. You find lots of small builders want to buy a 3 or 4 unit site. Lots of individual investors want to do that. It's when you get in, and so the returns it's more competitive, lower risk. The returns are generally lower. when you get into the much bigger projects, just also due to the fact that the timeline is longer and the risk is higher, people expect higher returns from those projects. So always consider that. You've got to look at your adjusted risk return. So yes, if you're got a high risk project, a much larger project, you should certainly be targeting much higher returns. If you're doing a lower risk one and a smaller one with a shorter time frame, you would expect that the returns are going to be simply less on that basis. Now, in Series 1, we said there are 3 key areas developers need to get right, and one of those was market understanding. Also, we talk about today project numbers and council regulations, but I want to delve into these a bit more. Let's start with market understanding. How do you assess if a development will suit the market?
So there's 2 key parts to that. It's data and local knowledge. So on the data front, we're looking at sales data, historical sales rates. We're looking at what product is on the market, what features those products have, what typologies they are. Are they 3 bed, 4 bed? What sort of product is selling? And also importantly, looking at what product is selling faster than others. That's the product we should be trying to develop. The other part to the data element is demographics. There's a lot of information available on census data, real estate websites, etc. You can have a look at what demographics there are in the area. There's no point developing a downsizer product in an area dominated by families. And then the second part to all of that is local knowledge. For all the data we can gather, we need to check that and make sure that what's actually happening on the ground reflects that data. So talking to local sales agents, particularly guys who are very active in the area, they'll give you a sense check and make sure that what you're developing or planning to develop actually meets those demographics.
Look, it's really important in target market needs. That's really critical. It's not just the size of the product or the type of product, is it? It's when you think, well, maybe there's downsizers in the area, and so they want maybe something with a lift and the bedroom on the ground level. That's something obviously we consider when we're doing a product targeted to those particular groups. But it's also the finishes, and it's about the quality. So people think, I can build a townhouse, for example, say $600,000 as an example. Well, you can, but in some markets, the quality of the finishes are just not going to meet those target market needs, are they? And so you might find you just simply won't find buyer, will you?
Absolutely, and you can get stuck with a product that you simply can't sell. Likewise, you look at price points. You might think bigger is better, but that might push the price point up to a point where people can't simply afford that in that area, or it's higher than the median house price or whatever it is.
And that's an important thing. If you're thinking downsizers, the median price needs to be a decent chunk above what you're going to offer, because most of those downsizers are going to be selling something. They want to take some equity out to supplement their retirement often and move into something smaller. So if the median price in your area, for example, is $1 million and you're providing a downsizer product for $1.2 million, you're going to find there's not many buyers who potentially have got that cash in that particular area. So all those things are really critical. And as Phil covered there, you've got to understand the market, what the target market wants, what drives demand in that area, and what are the competitions out there as well. That's important. I mean, we're looking at, it's great if you think you're going to provide a product, but if there's 5 other developments going to provide that same product, and it's not always easy to know. You've got to do your research and see what's out there, what may come in the pipeline in terms of what's got planning approval. In development, also you've got to think about future trends. Now, that's hard when a project might take 3 years. What's going to happen in a couple of years? But you don't always know. But they're the things you need to be thinking about when you're looking at doing market assessment of and understanding your market of what development will suit the area. Now, let's move to the numbers. What key calculations do you really need to understand as a developer to make sure you're going to make a profit?
So there's a lot of different calculations you need to be aware of. There's probably 2 key ones. So it's that return on cost or your profit margin. So looking at very simple terms, it's what is my profit margin divided by the total cost of the development. That gives you a percentage, and that reflects the risk that you're taking. So we talked about a 15% minimum or higher if it's a lower risk, getting closer to 20% plus if it's a higher risk development. The other one is annualised return. So we take our total development profit or return on our investment and divide that over the time frame of the development. That gives you a good idea of what you're going to get per annum, and you can compare that to the opportunity cost of doing a different development or another investment. So a more passive investment might get you a 7 or 8% return per annum. A development might get you 18% per annum. If that number starts to close in too much, it's just simply not worth taking the risk of the development. Our listeners might have heard of things like internal rate of return, which is a more sophisticated measure of that, which takes a better account of equity flows in and out of a development. So it's really important to understand what those two numbers are going to look like, and is the risk worth taking on the development. And I'll just throw out the other one is banking metrics. So I've talked about what we might look at before we take a development on, but it's also important to get the bank metrics right. A bank is going to look at a development. We're unfortunately not all going to be able to fund it ourselves. We'll need a bank to come on board, and they'll look at things like loan-to-value ratio, debt-to-equity ratios, and other calculations. We need to make sure that we can actually get that funding to do the development as well.
Yeah, that's absolutely critical. Getting the most of us are almost always going to be borrowing to do a development, and so if you don't meet the bank criteria, well, it's all a moot point. And talking about the numbers, so yeah, Phil mentioned internal rate of return. That's a methodology that certainly more sophisticated investors use, and institutions, and without going into all the complexity of it, the simplest way for a smaller scale developer or investor to look at it is exactly what Phil said. What is my margin on the cost? Is it at least 12% as a small scale development, and much more as a bigger development? And then simple maths, do a calculation. Well, if I'm going to make 50% over 3 years, roughly that's 17% or thereabouts over that. So without making it too complex with internal rates of return, that's 17% per annum. So things to think about. You've got to understand that. And doing a feasibility, one of the biggest mistakes I see people make is leaving out expenditure items. They don't, forgot about that. Well, that can kill your profit very quickly, can't it, Phil? And Phil also mentioned contingency earlier on the podcast. No matter what you do, a project is never going to go exactly as you plan it. That's just the nature, and sometimes it might go in your favour. I've had projects, and we've had projects as a business where we think they'll sell for X and they sell for X plus 20%, happy days. But also at the same time, the building costs can be X plus 30%, so not as happy days. You just, particularly as we've seen in Australia in the 2020s with the rapid rise in costs. So having a contingency allowance helps to mitigate potentially some of those cost blowouts that may or may not occur. And I think one of the most important things about financial modelling is not to be too optimistic, is it, Phil? Because when you're doing escalation, you've got a product you think is on a piece of paper today. When you're buying the site, it's very easy and simple to say, well, by the time I sell them, they're 30% higher. But that's pretty optimistic. I wouldn't be banking on that. And generally, we escalate, depending on the market, only a small percentage each year, don't we?
That's right. Look, if you're banking on massive escalation to get the project to work, you probably shouldn't be doing it. Yeah,
exactly. So lots to think about on financial analysis. And the other great challenge around the country is the local councils. Now, each state has got its own planning regime. Some of them are good, some of them are average, and some of them are ugly. And I won't name the states where they're ugly, but they know who they are, where it's very complex to get a project up and running. Let's just talk about council regulations. Phil, how do you generally navigate the approval process? What sort of process do you go through to engage neighbours, local community, council, etc., to get a project approved?
Yeah, so look, I guess the good news is it's fairly regulated. It's legislation, it's planning policies. They're all publicly available. They're published on websites, or you can go to the local government and speak to the local government and find out what the regulations apply to your site. The bad news is it changes from one site to another. It changes from one local government to another. So it can be quite complex, understanding what you can develop and what you can't. On top of that, typically we're seeking discretion. We don't normally just tick every box and get the development approved. Most sites will require a variation in setbacks or height or something like that to make the development work. So it's very important to understand what discretions you might be able to achieve and what you might not be able to achieve and what might be asking for too much. So it's really important to do really good due diligence there, go speak to council, really understand what the development potential of the site is, and in most cases get an expert planner involved as well, just to help you navigate that complex process.
Yes, if you're going to get into property development, there's one word you will learn, and it'll be forever etched in your mind, is the word NIMBY. And that means not in my backyard. And look, a lot of people in a local community are generally pretty good, and they understand that they need to have a choice of housing in their community, and they're reasonably supportive of development. But of course, there is a certain group of people who are against it, don't want to see any change to their local community, and I can understand to some degree that thought. But of course, we don't just live in our local community in a suburb. We live most of us live in a much bigger city where there's a shortage of housing, particularly in the inner city areas, and particularly housing choice. Not everybody can afford a big block in a suburb 15 kilometres from the city. They want to be able to get access to the infrastructure and amenities, but they can't afford a big house, so they want to look at alternative accommodation. So my favourite thing I've seen at multiple council meetings is when people get up and they say, look, I'm not against development, but it's just not suited for here. That's you've got a NIMBY who says they're not against development, but just not in my area. So look, there's a lot, and when Phil and the team go through a development project, liaising with the council, meeting the council planning officers, talking about conceptually what we're doing. In a lot of locations now around Australia, there's design review panels as well that you get external to the council, the planning officers. There's design review panels. It's certainly, it's a good idea to engage the community. I mean, ultimately it's your land, and you've got the right to develop that if it's zoned appropriately. But engaging the community to get some feedback. Again, some people are reasonable, some not, so you've got to take all that into account. So it can be a complex process. And again, in some states, they've got estate planning panels where you go through a estate planning process with some engagement from council. Other states still have the local council is the first determining body, and that makes it more challenging because local councils like to get re-elected and they get community opposition. They often go against a development. And so in those locations, it just factors in an extra 12 months of going through the appeal process, and ultimately that means higher costs. So anyway, I could talk about that all day, but yes, if you're going to be a developer, understanding the council regulations and that whole planning approval process is absolutely critical. And as Phil mentioned, getting some experts involved, planning specialists certainly can help that. But now, look, not everybody has to develop and build. We often think that we need to build something, but there are ways you can add value from development. I've done this myself a number of times, particularly in my early career when I was doing smaller scale developments. It's about strategic acquisition. So Phil, talk about strategic acquisitions. When might two properties combined be worth more than their individual values?
So it's about potentially unlocking a higher yield. So for example, things like a boundary setback on a small site may reduce the developable footprint of that site. If we purchase the site next door, that what used to be setback between those two properties becomes developable property. So that may increase the potential yield. Also, small sites are really hard to go up. There's costs like infrastructure, basements. A larger site which has a larger number of apartments or properties developed out of it, so you can amortise some of those larger costs across a bigger number of apartments or units and reduce some of those costs.
Yeah, I think also we're certainly seeing this around the country a lot more, and I've seen it in Sydney recently, in recent years as particularly, where the zoning, if you acquire enough land, suddenly instead of being maybe a single asset site or a duplex site, suddenly can turn into a much bigger apartment project. And I've seen in the AFR and in the last couple of years where communities are coming together, 4 to 6 people coming together saying we're willing to sell in one line, and they might get 30, 50, 80% more for their value. So they're taking advantage of the accumulation. If you can put it together yourself as the buyer, you can go and buy a site and I remember in my early days of development, I was able to buy what were single sites, putting two together, you could sometimes get 3 and even 4 units on them. So a great potential way, but again, you've got to understand the planning schemes and how combined sites might be worth more than their individual values. Also in development, you don't have to go through the entire process and develop it and build and sell at the end or rent it out. You can exit part way through. And so Phil, tell us how securing planning approvals or potentially even rezoning a site add value without even laying a brick.
So if you can increase the zoning of your land, then obviously you'll get a higher yield on the development. So that's going to increase the value that someone might be willing to pay for your land. Likewise, if you can get a development approval that increases the yield or has concessions on height or yield or return or things like that, you also may increase the value of your land. But obviously you need to make sure that development approval that you obtain and the money you spend obtaining that development approval is actually going to meet the requirements of a buyer.
That's a really important point, Phil, is first of all, if the approval that you get is not recognised by the market as being of much value, you really don't add anything really to the ultimate sale price. People will go, well, I've got to go back to square one. So you've got to make sure it's something that is you're getting approved is adding value. It does tend to add a lot more value in locations around the country where the planning approval process is more complex, i.e. where you've got to go through local councils and then often appeal because they're against it. And then so I've certainly noticed more in those particular locations where the value of a permit or a planning approval is worth more than it might be in some other locations where the approvals process is a bit easier. But ultimately, the planning approval, if it's a good one, is not only de-risks this project, but also it saves you time because we know that can take 12 months, sometimes longer.
Exactly. We talked about annualised return earlier in the podcast, and that's the key. If you can shorten the approval timeframe for somebody by going through that process, you potentially add the value because their timeframes are going to be shorter. And
just one thing I want to cover off in rezoning. I've had a lot of people over the years come and talk to me about their particular property and they want to rezone it. And sometimes it's been someone who's just got a suburban block in the middle of a suburban street, and for some reason they think that that site should now be zoned for 6 townhouses or whatever that might be. Rezoning is a long process, challenging, and there's got to be a really compelling reason because the council's often gone through a planning process to get their planning scheme in place. So just be aware of that. You've got to have a particularly large site or a particularly unique site to get it rezoned. It doesn't just happen because you particularly want it. So something to keep in mind. Rezoning is a bit more challenging. So
and that's where having a larger land holding also helps. You have a larger land holding, you've got more sway with government or with the local government to try and get a rezoning. Yeah,
absolutely. So look, development has to be viewed as a business proposition, doesn't it? It's not a get-rich-quick scheme, even though we see, we've seen, as I said earlier in the podcast, over the journey, a lot of very wealthy people in Australia have made their money from property development, but plenty have lost money as well. It does take time, money and expertise. So why is partnering with a team of experts so crucial in development?
So as we've discussed, it can be very complex, it's risky, and it's a good idea to have an expert team that manages that risk for you. They've done it before, they know what they're looking for, they can plan for the issues and give you the appropriate contingencies. So, from a sales perspective, you need that local knowledge we talked about from a local agent to know what's selling. You need planners to help you navigate the planning system and get the approval and maximise the approval that you can get. Planners, architects are important, builders also, so you need to know what it's going to cost you to develop. We can make an assumption on what it's going to cost, but you need that on-the-ground knowledge from a builder or a quantity surveyor to make sure that your feasibility stacks up.
Even if you know what you're doing and you're running the development yourself and you don't get a development manager in, there's often 20, 30 other experts and consultants you're going to need, depending on the scale of the project, but certainly the bigger the project, particularly when you get into multi-residential apartments. I lose track of all the consultants that you need through that process. So just be aware, no matter, even if you're managing the development yourself, you are going to need lots and lots of different consultants and experts through that journey. And certainly that's the great challenge, getting everyone coordinated, organised to move through the critical path to get your project completed as quickly as you can and on budget as well. Also, that's really critical. Now, in development, a lot of people think just about residential development. You've got to develop and sell, but of course, you can develop commercial property. There's plenty of commercial property developers out there who don't always sell. Sometimes they hold on and rent at the end. But of course, as we all know, development is very capital intensive and it's out of the range of most people, whether that be residential or commercial. So talk about property syndicates or property funds and how they develop property and how investors can participate in those without necessarily having to do it all themselves.
Most people typically don't have the capacity to buy a $5 or $10 million site. They simply don't have that sort of cash lying around as equity to invest in a development. So a pooled investment through a syndicate allows you to access these larger sites for a smaller outlay in investment.
Yeah, and so you can be, for example, if the project was raising $20 million and you put in $200,000, you would be 1% of that project, meaning you'd participate in 1% upside on either profits, so you can be part of a much bigger project. And again, not everyone is developed to sell. There are projects out there, And there are even funds where there's some of the funds are passive holds in commercial and some are value adding and developing some of the properties. So there's lots of different ways you can participate in development without necessarily having to do it yourself. So now, Phil, one of the reasons it's great to think about spreading your risk across multiple developments, potentially through funds, is of course the risky nature of development. I think a lot of people forget that there is a lot of risk, and that's why the returns need to be much higher that you're forecasting when going in, because it doesn't always go to plan. So what are the main risks developers face when they're looking at a project? What are the key risks that we look at?
So I guess it's complexity. We're doing larger developments, they're more complex, there's planning regulations, there's a lot more consultants you need to pull together, there's a lot more things that can go wrong. So one of the benefits of property syndicates is you've got that expertise on the ground, an experienced development manager or syndicator that's managing that for you. You look at the planning risk as well. Like we said, not every development's going to tick all the boxes, so having someone that understands the planning regulations and the way to navigate that through and to get the approvals, and also experience in developing similar product, whether it's commercial or residential. They've done it before, they know the costs, they understand the timeframes it takes, and so they can manage that feasibility for you.
Yeah, there's a lot of risks through that project. You mentioned the planning approvals process. There's builder risk, there's cost risk, there's sales risk at the end if you're selling those projects. So there's lots of different risks in going through development. That's why you really need to understand what you're getting yourself into before you go into a project yourself, or if you're going to a fund, making sure you understand what those risks are, because there is certainly no guarantees on the returns you're going to get. So what sort of safety net things can developers have in place? Now, you can't de-risk it totally, but what's some of the things that a developer in a fund, or whether it's a developer direct, should be looking at to at least help reduce some of those risks?
So at risk of saying the same thing again, it's margin and contingency for risk. So understanding what are the risks, and am I getting an appropriate margin for taking on that development risk, whether it's your own development or in a fund, really looking through those numbers and making sure that makes sense. If it's your own development, it's also having access to additional equity and lending. Things will go wrong. If a builder goes broke, for example, you might be asked to put more money into by the bank to get the development completed. So you don't want to have everything tied up in one development or in one fund, to make sure you've got that capacity to tip in some extra. Always assume things are going to not go to plan, so diversify. Don't put all your eggs in one basket, whether it's, again, funds or developments. As we said, don't put it all in one basket in case things go wrong there. And also have an alternative plan. So if you're doing a development, if things change once you purchase the site, you may flip to a different development typology, or you may finish the development and realise the market's gone down, and end up holding the development for a longer period of time until market conditions improve. So it's all about having those contingencies and different options and thinking that through.
And a couple other things, I think, certainly when you're getting a builder involved, ideally you'll get a fixed price contract. Now, that's not always possible in the 2020s in Australia. That we've seen a lot of builders be less willing to go into fixed price contracts because of the escalations. But certainly things like trying to fix your price on your building contract as best you can. Other things are pre-committing or a lease. So if you've got a commercial property, ideally you've got a commercial tenant ready and lined up to go into that premises, so that de-risks the cash flow at the end. And certainly if you're selling, if it's apartments perhaps you might be selling, looking to pre-sell some of those. Now the banks may require you to pre-sell some of those depending on the size of your project, but that can help mitigate risk. So, I've done pre-sales in my own projects, and we've done them in our funds. And sometimes you're glad you pre-sold, because at the end of the project, the prices maybe haven't moved, or even in some cases gone backwards a bit. You're glad you pre-sold them. Sometimes you're not so glad because you sold them, for example, for $800,000. At the end, they're worth $1 million. But it's a risk mitigation strategy, and it's part of how the industry works. So you've got to weigh those decisions up. And again, a lot of times the banks will tell you how much pre-sales they want. Now you can sell more, but certainly there's, particularly in apartments, there's a pre-sale hurdle often required to get the bank funding, and that's about obviously the bank wanting to mitigate their risks as well. So Phil, how much would you suggest? And again, we're not giving financial advice here, but we certainly do see investors looking to get into development. Obviously, everyone's got a different risk profile, and potentially people might invest maybe up to 10% of their portfolio in property development. But how does that fit in with a broader property investment strategy?
So it is risky. You need to be comfortable and be able to sleep with that risk. You should typically you wouldn't put all of your money into property development because not every one of them is going to go to plan, and you can lose your equity or your investment capital. So typically, if you're in a capital growth phase, you're more willing to take some risk. That's the time you would do it. If you're moving towards more of an income phase, maybe going close to retirement and you want stability and certainty, that's a time to probably pull back from development.
Yeah, and I look at it this way. As I said earlier in the podcast, you always see the rich lists and in the various publications, and there's plenty of property developers on those lists. But what people don't see is for every one of those, there's probably dozens of people who kept betting it on black and kept taking those big risks who went by the wayside and lost everything. So our philosophy is generally if you're going to get into development, it should be potentially a smaller part of your portfolio. It's got to be suitable to your risk profile, and maybe 10% in totality of your portfolio, because for most of us, we don't want to keep betting it all on black. And one day, unfortunately, for many of us, red would come up. And if you haven't planned your portfolio well, that could certainly have a huge impact on your financial stability and your financial circumstances. So certain things to think about. Phil, what would you say a key piece of advice for investors would be if they're considering property development?
So look, it can be really exciting. There's a lot of great potential for returns in there as well, but you really need to understand those risks and your risk profile and make sure that they align and that you're comfortable to take those risks.
Yeah, I think that's just crucial. It's high return because of high risk, and you've got to understand that and be prepared. Contingency allowances, but even that you need to be prepared. Worst case, you hope not, but you can lose some of all of your money. So just be aware of that. So look, property development can be a powerful way to build wealth, but it's not always as straightforward as the silver screen suggests. Success in development isn't just about spotting an opportunity, it's about managing the risks, getting the numbers right, and having the right team behind you. Whether you go hands-on or invest through a fund, having a clear strategy and expert guidance is absolutely essential. So thanks, Phil, for joining me for today's topic, and thank you for listening. Next up, join me as we dive into Step 8. Thanks for tuning in. If you're enjoying the podcast, please take a moment to rate us to help others discover the show. Please note that the information shared on Property Investing Roadmap is general in nature and doesn't take into account your individual circumstances. The information is for educational purposes only and should not be relied on for investment or financial decisions. Always seek professional advice before deciding whether to invest. Always read the PDS, TMD, or information memorandum when considering financial products. Past performance is not a reliable indicator of future performance. Today's guests are representatives of Westbridge Funds Proprietary Limited, AFSL 533936, and Westbridge Property Securities Limited, AFSL 238386. Please refer to the terms and conditions at westbridgefunds.com.au.